Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua. And over the next 30 minutes, we'll be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. Trading tech volatility when stocks make big moves. How can ETF investors steer clear of trouble and keep their portfolios in the fast lane? Despite a meltdown for some sectors, equity ETFs continue to see inflows, grabbing the lion's share of new money this month. We'll bring you all of the moves from around Europe. And not so smart, new research says smart beta strategies that look great on paper often lose money after they launch. We'll dig deeper into the numbers. So it's been a dramatic week for tech investors, so let's kick off the show with a look at which countries and sectors have been attracting the money. Here's our Danny Berger analyzing the numbers. Hi, Danny.
Hi, Francine. In short, tech ETFs have gone wild as the tech sell-off accelerated. Now, ETFs are a really important tool during sell-offs like this because they give you broad exposure. So we often see investors buying and selling them to hedge or to get rid of their exposure or maybe buy in to that sell-off. So here I have the value traded for the Qs. That's the NASDAQ tracked ETF in the U.S. And value traded reached a record on Friday, September 4th, reaching $35 billion trading hands. Now, this blue bar I have down here is volume for TQQQ. It's a 3 times leveraged NASDAQ 100 ETF. We've seen a lot of the Robinhood retail investor crowd trade into that. So maybe that's less professional traders driving some of the flow. Now, let's get to FFLO Go. This is a function where you can track the flows in Europe specifically that we're looking at. And of course, we've had concerns of a second wave in Europe, as well as economic concerns that brings with it. So no surprise here, we are seeing outflows. Take Spain, where we're getting another spike, a lot of Spanish ETFs selling off. At the bottom of the leaderboard, though, is Germany. We did see one U.S.-listed German fund get inflows. If you're thinking about out of growth and into value, Europe might be a place you want to go, but still, on a net basis, we're not seeing that. So Germany having outflows of 69 million for the week. Then you look at the UK. That's another important area as well with Brexit concerns re-emerging. UK seeing $28 million vanishing from ETFs that track that region. Now, a lot of that is in gilt ETFs. We've seen 2-year gilt yields continue to plunge to new lows. So if you're looking for yield, the UK is not where you want to be. Of course, the falling pound has benefited the FTSE 100, but we're not seeing that in ETF flows. ETF investors taking their money out of equity funds that track UK stocks. Francine?
Danny, thanks so much. Danny Berger there with some of the big moves. Now let's discuss the growth of Europe's $1 trillion ETF market. Despite the tech sell-off, equity ETFs have grabbed the lion's share of inflows this month with almost 60% of net new money. Now, the rest has been split almost equally between commodity products and fixed income ETFs. Joining us now is Peter Thompson. He's head of European ETFs at Goldman Sachs Asset Management. Peter, I haven't spoken to you in a while, actually. And at the time, pre-COVID, almost pre-COVID, we were talking about, the European market, how small it was compared to some other aspects and so there are other parts in the world. How has COVID, if at all, catalyzed some of the ETFs here in Europe?
Well, Francine, I think it's played a couple of factors, right? I think it's reinforced the sense that the ETF market can be a point of price discovery and a point of liquidity when the markets are volatile, which we obviously saw back in March and April at the start of this, and now we're continuing to see into the autumn. So I think it's really reinforcing that movement towards this kind of fund structure that is liquid and tradable and transparent, and whether it's corporate bonds or tech, or we'll talk about smart beta. It's really reinforcing the sense that these things do what they say on the tin and that they work well in volatile markets.
So, Peter, the more volatile the markets, the more interest there is in certain ETF products. Does it, how quickly can you actually make some of these products?
How quickly can you make them? It takes multiple months to launch a fund, Francine, right? It's getting faster, right, as the regulators get more more familiar with them. But I think, it's just the flows are moving so quickly now, right? When you've seen what's happened in tech the last couple of days, obviously your part about the volume in the queues and some of those products, is just exploding. But the fund structure is working, the liquidity is working, the secondary market is working, the exchange role is working. So it's really reinforcing this sense that it's a great tool, when markets are volatile.
How much are you expecting the European ETF industry to actually grow in the next 12 months?
Well, we're up about 65 billion on the year, so that's roughly in line with with last year. So where that goes, I think it's double-digit growth. It has been for many years. We expect that to continue, and then it's kind of I think the trends in the market segments and countries here in Europe, Francine, that we're seeing, whether it's retail usage, which is definitely growing as they're getting more popular in those, intermediated channels, or bigger institutions getting into areas like ESG. So, double-digit growth in the teens, well within reach.
So we'll talk about ESGs a little bit later, Peter, but how much of demand is there for either, Chinese-linked ETFs or even like fixed income ETFs?
Yeah, well, I think in the spring, March and April in particular, in the corporate space, there was this huge demand, right? And then the U.S. move by the Fed to buy, credit through the ETF market, I think was another, kind of credentializer for the products. So we're seeing that continue, and then it's just what mood the market is in, right, in terms of risk on, risk off. But I think that credit market in the spring was a real signal for us of how strong these products are, and how well they work in terms of price discovery and liquidity.
Peter, thanks so much. Peter Thompson there from Goldman Sachs Asset Management stays with us. Now, coming up, when smart is not so smart. A new study says hundreds of smart beta strategies look great on paper, but actually lose money after they launch. We'll discuss that next. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, a new study says hundreds of smart beta ETF strategies look great on paper, but actually lose money after they launch. According to researchers at the University of Washington and the University of Hong Kong, the average above-market return for smart beta strategies before they're listed is 2.77% per year. But once they actually become ETFs, that flips to a loss of 0.44% after fees are taken into account. Well, joining us on the phone now is Athanasios Psorafagis from Bloomberg Intelligence. Athanasios, great to have you this week with us. What do you think is the cause of the underperformance once these ETFs actually go live?
Hi, Francine. Good morning. Sure. So there's a big disconnect between sometimes the test laboratory where researchers are working on index providers, and then when a product actually needs to come to market and actually needs to face some real-world headwinds. So one thing is what feeds into this. One thing you mentioned, the fees, obviously. A lot of these back tests, they don't factor in fees. But when we expanding on fees, there's just total cost of ownership, right? And when you're actually have a product out in the real market, there's things like trading costs, depending how often the fund rebalances, tracking error. So all these real-life costs now get embedded into the real product that's being launched, and sometimes don't get picked up on the back test. The other thing, and the beauty of a back test, is just biasly, we have the beauty of hindsight, right? So if I'm building a great back test, I know that in 2008, I should probably avoid financial, so I'm going to pick one that probably does really well during that time period. And I think this plays onto a bigger notion of just, as investors, we have much better access to data than we ever did, right? So even someone at home is able to get data now and build their own back test. So I think that just the expansion of it, just having data easily accessible, has probably made the efficacy of these products a little bit less strong as they're being launched recently compared to when you're running these back tests historically. But I think that it's sort of surprising, but it's not. It's just, most products that launch are going to be launched off a back test that just looks really good. It's just easier to sell that type of product. But I think that, these sponsors are now seeing the reality of when you bring a product to market, there's different headwinds that necessarily aren't being picked up in a back test.
Athanasios, what does this mean for smart beta then as a whole, and are you still bullish on the category?
Yeah, we are. And one thing that this report mentioned as well, and I think that it sort of went undernoticed, was there's still $1 trillion in the smart beta category globally, right? So despite this underperformance being live, people are still allocating to smart beta. And if you look at why and why we're still really bullish on the case, one, it's still really cheap compared to a lot of the active funds that they're going up against. And I think this is the crux of it, is that who's the real market that they're going after, right? They're not necessarily being measured against themselves. They were made and designed to really be a replacement for active managers. And if you look at it in that context, smart beta still does really well. Their outperformance rates of active are still really strong. And I think that it's going to still be demand for these products. And even more so in Europe, where smart beta represents just only about 10% of the market compared to 20% in the US. So I'm still very bullish on the smart beta category, probably even more so in Europe, where it's still very much an active. The breakdown favors active more. And I think as more of these assets move over to passive, they're going to find their way into some of these smart beta funds.
Thank you so much, Athanasios Psaroufagis there from Bloomberg Intelligence. Now, still with us, Peter Thompson from Goldman Sachs Asset Management. Peter, do you agree with what we're seeing in terms of smart beta being better for you, before you buy it, and can that change in the future?
Well, yeah, Francine, it can definitely change, but I'd say, no doubt there's been a proliferation of these, of these products as this concept has become more popular, and most of this based on factor investing, right, and research that goes back decades, academic research. But I think there's work to be done at the individual or institutional level in terms of exactly what you're getting, right? In terms of, is it a single factor like momentum or value or growth, or is it a blended factor approach, right? One of the things we've done at GSAM is and historically have done, is the multi-factor approach that diversifies amongst factors. So it is really one of those things that investors need to understand what they're getting and to study it and to look, to the point made about back tests. Yes, all these are based on back tests, but then, how long have they been running as strategies, actively, and what track record do they have?
But Peter, smart beta, I think, these wrappers are basically worth $1 trillion across the world. Do you see that changing? Is there going to be less appetite for these kind of products?
We don't think so. We think that trend continues, Francine, right? It is, it's a search, when you think of, smart beta, a search for better risk-adjusted return, right? Relative mostly to market cap, but also to active management, right? And so and it's backed up by, a great deal of research over long periods of time. So we see that trend definitely continuing.
Okay, Peter, thanks so much. Peter Thompson there from Goldman Sachs Asset Management stays with us. Now, up next, are investors playing a price-only game by investing in the bond market? That's the take of one fixed income strategist from JP Morgan. We'll look at what ETFs are currently being bought and sold in Europe. That's coming up shortly, and this is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, in a moment, we'll look at all of the week's winners and losers. But first up, let's focus on green investing. According to analysis from Citigroup, about half of all new ETFs in Europe, the Middle East and Africa this year were ESG related. Now, green funds actually took in more money, that $4.2 billion in assets, than non-ESG funds, which attracted $3.8 billion. Well, still with us, Peter Thompson from Goldman Sachs Asset Management. Peter, how do you explain this pickup in demand? Is it partly, as the health crisis and the economics crisis, you see a lot more countries and the European Union trying to go through this green transformation, or is it just on returns?
No, I'd say undoubtedly, Francine, it's been impacted by what's happened this year in particular with the COVID crisis. But I think, this was coming, right? ESG was getting bigger and bigger. And, what's happened has just kind of catalyzed that, I think made people think really hard about, what that means. And I think in particular, the S of ESG that's been highlighted, so dramatically by the COVID crisis has really changed things, with the way people are considering this from an investing perspective.
Because we don't really have a taxonomy, we don't have a common language. Peter, once we have that, do you think that the demand and actually, the products will grow significantly, or is it something that's secondary?
No, I think this is a significant area of growth, almost unqualifiably, Francine, right? And I think we're seeing also, and it depends on the country, of course, but particularly in Europe, regulation is really starting to drive some of this change. So from the top down, but then you're getting that bottoms up, that grassroots, just folks asking their advisors, how is this investment I'm making fit, kind of societally, right? And asking those questions. So I think, the ETF market is one that's well suited to help in that respect. And that's why you've seen, I think it's, 40 or 50 new launches of ESG ETFs just this year, in 6 or 7 months.
So, Peter, do you have any, how much is the ESG ETF market as a proportion of the rest of the ETF market in Europe, and how much will that grow?
Yeah, it's, I think globally it's around 10%, Francine. It kind of depends on how you measure it. But in a proportion of new funds launched, you're looking at about 2/3 of the new funds in Europe are ESG, right? So this is really something, that is becoming very prominent. And in terms of people looking at, benchmarks they've held for a long time and saying, do I need to reevaluate these relative to, the E, the S, or the G, or some combination of that? And you make a good point in terms of, the data is catching up, right? Not yet standardized. And in particular, the S is harder to quantify, but we see this as a long-term trend.
All right, Peter, thanks so much. Peter Thompson there from Goldman Sachs Asset Management stays with us. Now let's let's take a pause to look at ETFs, which are currently attracting the money, with Danny Berger. So Danny, ESG, part of that story over recent days.
Francine, you and Peter really set this up perfect for me. At the top of the leaderboard over the past 5 trading sessions is an ESG ETF. Now, it's an exclusionary one, which means that the way that it's set up is it excludes non-ESG stocks rather than really focusing in specifically on environmental, governance, and social stocks. So that got $338 million worth of inflows over the past 5 days, as I said. Now, the next one is gold. Now, I think it's really interesting that these two saw almost mirror image inflows to each other. As Adeline Diab, our Bloomberg intelligence analyst, puts out that wrote recently, ESG ETFs are behaving a lot like gold. Perhaps they'll protect you from some downside. They're an alternative to a more low volatility asset. So both of those looking really attractive over this period when we have seen some sell-off in markets. Now, the final one there, it's an iShares EM bond ETF. This one denominated in US dollars, so perhaps some people looking for yield, as other US Treasury, for example, see yields move further. Now, I want to stick with Treasuries and show you what the losers look like this week, because you'll get a very specific flavor to them, and that's that they're all Treasury bond ETFs and other bond ETFs. So at the top of the leaderboard is a 7 to 10-year bond ETF offered by DECA. Next, we have an iShares aggregate bond, followed by a corporate bond ETF. Now, this comes on the heels of JP Morgan Asset Management warning fixed income investors that too many of them are just fixated on price. And they're doing this really sacrificing capital preservation, saying that this is a mistake because it's not a question if, it's a question when the bond rally will end. JP Morgan, for their part, their strategic fixed income fund has zero allocation to U.S. Treasury. So these warnings being felt throughout the market here, certainly among European listed ETF. So Oksana Aronov, she says bonds have become a get-rich instrument. That's not what they were meant to do. If you look out at 3 to 5 years, the story for bonds is a pretty bleak one. So that sentiment really captured in this week's ETFs winners and losers. Francine?
Danny, thank you so much. Danny Berger there with some of the things that moved this week. Let's get some final thoughts from Peter Thompson. He's from Goldman Sachs Asset Management. Peter, you know, one thing that caught my attention actually is non-transparent ETFs. I mean, has opaqueness ever worked for anyone? What are these ETFs anyway?
Yeah, well, you know, that's a trend starting in the U.S. And it just started, you know, oddly kind of this spring, Francine. But it's that sense of putting an active strategy into, you know, an ETF wrapper with not the degree of transparency that you're used to with an ETF, where you see all of the constituents every day, and that is designed to protect, you know, the intellectual property of the active manager. So that's just started, but it's, you know, it's off to a, you know, an interesting start in the States. You know, is growing quite rapidly. It's still very niche, but you know, once again, we think there's probably, you know, a growth story there, but it's going to be the, you know, the public getting their, you know, their heads around that sense of how is this different from my normal ETF. But once again, it's, you know, it's the adaptability of the wrapper, you know, seems to be working in that space, but it's just starting, very early days.
So, Peter, do you think it'll catch up in Europe?
I believe it'll come here, right? I mean, you know, in some sense, we follow the U.S. in the ETF market. I think, you know, ESG, you know, is an exception to that, where we have, I think it's about 75% of the sustainable assets are in Europe, right? And ETFs leading that charge. But yeah, I think, you know, I think it'll turn up here, you know, maybe in the next 12, 18 months, Francine.
And just final thoughts, Peter, when you look at some of the other things that, you know, we should be mindful of, what's the volatility going to be like in ETFs from now until the end of the year?
Well, you know, I think we're still going one way here, right? You know, the assets are going to continue to grow. This is still, you know, a growth market and a growth product. You know, it's kind of where it goes next. I think, you know, like you highlighted, ESG is a space, you know, we really need to keep an eye on, because that's, you know, that's just front and center right now. And then it just depends on, you know, the overall volatility of the market. But again, you know, the ETFs, inflows, outflows, you know, you look at volumes as much as you do assets.
Peter, thank you so much. Peter Thompson there, head of European ETFs at Goldman Sachs Asset Management. This is Bloomberg.